One Step Ahead by Lundquist and Beslik.
Welcome to One Step Ahead Radio. This is another session, another week, and this week I will be hosting a special guest. We have Antti Savilaakso, one of the people that have been in our industry, sustainability, ESG investments for many years. I've known him since over 20 years ago, and I'm happy to host him here in Tokyo. Welcome to One Step Ahead Radio, Antti.
Thank you, Sasja. Good to be here.
How does it feel to come to the biggest city in the world? Is it a special feeling? It's your first time in Tokyo, yeah?
Oh, that's correct. Correct. Yes, I used to live in Singapore for a good year, and then I also studied in South Korea. So I've been in the region, but I somehow managed to avoid being here, despite being around quite a lot.
No,
It's good to be here.
fine. It's good to have you here, and welcome to Tokyo. Welcome back to Asia since you've been here before. Antti, could you give us a bit of a background of? I know you very well, but for the people listening, who you are, what you're doing, and a bit about the company that you work for.
Yeah, sure. So I'm Finnish by passport, engineer by training, but like you mentioned, I've been doing nothing but ESG data for 20 years. I checked on LinkedIn. We met 20 years and 2 months ago, so just over 20 years ago.
That's fantastic.
Time flies.
We've been in this game, sort of a never-ending game, for over 20 years. So.
Yeah, exactly. So on the last almost 10 years, we co-founded a company called Impact Cubes. I'm there heading the research and data where we basically do ESG data and services. About half of our clients are what you would call a typical ESG data clients, but we have a pretty substantial kind of a solutions business, which we help companies with their ESG reporting, ESG communications, but also what we call investment solutions, where we build indices and benchmarks and portfolios based on the data that we have.
And it's so many new sort of popping up mushrooms after the rain companies right now around the world on ESG data, and you can dice and slice in so many different ways. What's the different? What's unique with what you guys are doing?
Yeah, it's a good question. And yes, you're right. There's quite a lot of it seems that there's a pretty low barriers of entry when it comes to ESG data and services nowadays. So we are maybe the biggest differentiator is that we are all of the founders. We are come from a very, very substantial investment background. Most of us have had a career in asset management. So we use the tagline for investors by investors. In more practical terms, it means that we factorize ESG data. That means that we don't use ratings or scores, but instead we organize our data as an ESG factors. And then when you factorize data, you can do anything that you can do with the financial factors, then you can do with the ESG factors as well. So ranging from risk management and screenings and stuff like that, the usual stuff. But more often than not, we use it for a portfolio construction, portfolio optimization, and things like that, and try to kind of basically come to this with an idea that the ESG used to be, and some people still think that it's quite binary in a way that your company is either ESG compliant or not, or it's sustainable or not sustainable. Whereas we see that it's much more nuanced. And when you use the ESG factors, you can tell that every company has a bit of a positive, bit of a negative stuff going on for them, and then you can build a portfolio and your investment decisions around those nuances rather than this bulky invest or not invest type of thinking.
But I mean, just for people not really being in this world, I mean, when you say factoring, what you're actually trying to do, if I understand you correctly, is to adjust the relevant ESG data points as financial in the modeling when you model your investment portfolio. Is that correct? So, I mean, just to make it clear what it is.
Yeah. So that's one of the. So there's quite a few things that you can do with it, but that's one of the primary ones, and that's one that we are quite well known for as well. So you can follow, once you factorize ESG data, then you can follow factor performance, and then we can kind of pretty definitely answer the question: are ESG issues? Is there ESG alpha, or are ESG issues material? And we can pretty definitely tell that. Well, yes, there is, but not for all companies all the time. So
Yeah.
basically, just like any other factor, it varies. It varies depending on your sector, your region, and then it
Yeah.
depends and so on. So more often than not, there is, but it doesn't mean that it's always there and on every market situation and things like that.
I mean,
Yeah.
you've been in this game for many years. I mean, people are, reading newspapers, listening to podcasts, reading reports, listening to what everybody's saying about the ESG and sustainability. And there is a question out there saying that, okay, but we've been doing this for so many years. Are companies getting better on reporting? That's one thing. Are they actually getting better in shifting their business model? That's the biggest question. So what's your take on that?
Yeah. Yeah. Well, first of all, let's agree that yes, companies are definitely getting better at reporting. The number of data points that we can access and what we process that kind of keeps creeping up pretty systematically to the point where I would argue, maybe that's another topic, but to the point that I argue that it starts to plateau a bit. Like I think we are still
We're
reaching
going to
the
talk
limits of
about
how
that
much
too.
there. Yeah, let's talk about that separately. But whether they are transitioning, um, not much, not much. I mean, you can see the transitioning and so on. So maybe there's the inertia thing that seems that the kind of large ships take time to turn, but it's in some cases it's pretty fast. Capital markets change quite fast. So new companies pop up and new business models pop up and so on. And then you can see it on the AI company valuations at the moment. But the kind of a fundamentally the kind of a course of the economy changes unfortunately quite slowly.
Mhm. I mean, there are so many companies, and of course, especially the public listed ones that are reporting, on the relations pages. They report, this is our score from one of the big providers out there. This is our score, ESG or sustainability score. I mean, there is something wrong about this because these scores are actually quite, how you say, I mean, not really telling the full story. And I think it's sort of destroying a bit of a discussion about what ESG is. So what's your take on the scores? I mean, this is a big business, Antti. These big third parties, they're making a lot of money on providing scores that are actually not making any difference. So what's your take on it?
Yeah, yeah. Yeah, so okay, so let me just state it quite bluntly that I said it already. We don't particularly like the ratings and scores, and yes, they're absolutely distortive. So look, we've been talking to CIOs and portfolio managers among our space, mostly invest in Europe in a kind of hundreds and hundreds of meetings in the past 5 years, and we haven't found a single one a serious investment decision maker that likes scores or ratings. Not a single one. There used to be maybe a handful, and they have their use cases, but not a single one. There's two groups of people. Actually, now that you mentioned the third one, there's three groups of people that actually like ratings. There's the journalists or the communication people because the rating changes makes wonderful stories. Tesla gets downgraded or this industrial company gets downgraded. It's newsworthy item, so that's a good one. Academics like them because they don't have much else to work with, meaning that the ratings are easily available, so you can do better rated companies outperform. And then maybe the third one that you mentioned, companies that perform well like them, because that's a kind of an easy, quite cheap way of kind of propping up their ESG profile is to kind of put this on their website on in their reporting and so on. But they are not particularly useful. Fundamentally the problem being is that they are very subjective, meaning that they are just someone's opinion on something. They often focus on the wrong things and omit the things that they should be focusing on. They are kind of slow to move around. There's all kinds of a kind of a structural problems with them that makes them effectively very not usable for a serious investment decisions.
Yeah, but it's also very sort of interesting that the companies are somehow happy with virtue ratings, which in my book they are, because it's more about assessing the virtue side of the business, not really a value side of the business. And investors are looking for the value side. So I mean, the current score system that is used is not reflecting the value proposition there is embedded in a business model or anything that can help investors to realize or materialize return going forward based on factors that particular investor likes related to ESG. So the value prop side is for me probably one of the most interesting things, because we are moving away from now it's a level playing field. It's the same. Compliance has made the reporting improve for the lower quartile of the companies that haven't done anything before. Now we have something else. But will that lead to more clear, understanding of where the value prop is for some of these companies that are really trying to do something on ESG? What's your take on that?
Yeah, yeah, I think so, and I certainly hope so. I think the ESG is a very, very probably one of the broadest churches that there is out there, because it can be anything and everything. Anything stuff related or raw material related tends to be environmental, and anything people related tend to be social, which means that you can put anything under there. That's one of the I suppose problems with the ESG, not only ESG ratings but ESG industries at large, that we kind of have been talking about them on a very, very similar terms. Value propositions are very specific. Like you either are good at sourcing or sustainably in sourcing your raw materials, or not, or you have a good kind of competitive employee base that you kind of know how to work with, or you do have a good governance structure or not, and every single one of them then translates into a financial metrics, and from through that a kind of a proper investable shareholder value. So if I think
Yeah.
I think so.
I have this very interesting experience when you meet companies. You ask them, what are you best at in terms of sustainability or ESG, whatever definition they use, and they look back and they look at you and they sort of try to sort of grasp the question. What I'm trying to say is that what are you excelling in comparison with your peers? So I can sort of, as investor, look at it and see, okay, could be a value. And that's very difficult for companies to do because they actually haven't been working with this. Because sometimes some company can tell you, yeah, our product range is much better than our competitors because our OPEX and CAPEX are better, our supply chain, efficiency is better, our pricing model is better, whatever. But when it comes to the ESG, it's very, very difficult to figure that one out. Do you think that will change going forward, that companies will be forced to do this?
Yeah, maybe I'm not sure if it's forced, but it's kind of like when you once you kind of work on that value proposition level and on that level of detail, it becomes very natural for companies to work on it and so on. So in you talk a lot to companies, or when I talk a lot to investors, and you every now and then you kind of find this very kind of a skeptical portfolio manager that comes to you and says that in a conference or so, and say that, oh, I don't believe that ESG issues are material. And then you look at their portfolio and they have very energy kind of industrial companies, them. And then you ask that well, what about energy efficiency? And then goes like, well, of course I'll look at the energy efficiency, right? It's an investment issue. It's not an ESG issue. And they go like, well, there we go. I mean, it's exactly the same thing. Like and this by the way is one of the things that I really like to be in Asia for. Like the sentiment around here is very tangible and concrete around this, on this kind of actual kind of a concrete issues, rather than kind of talking about the very lofty heights of ESG-ness on sustainability and corporations' role in a society, which tends to be dominated or dominate the European conversation.
Yeah, but you actually echoing a bit what my perception of, as well, on what's going on in Asia. It's much more pragmatic. It's straight to the point. It's trying to figure out where the value is and try to sort of invest in that in order to sort of excel and scale that. And I think the differences are probably that still in Asia, due to the fact that there is no regulation that is pushing companies to do that. There is a lot of space for innovation in various shapes and forms. And I think that is also the reason why I think this region will, take on some of these things much faster than in other places in the world. But there's another topic I want to talk to you about, because this has been puzzling me for years, and that the topic of third-party verification of the data published by companies. You see, Antti, that there are companies producing a lot of data on, let's take CO2 emissions as an example. So you have cases where the company X says that we have taken down scope 3 emissions for this much from previous year, whatever the benchmark year they used. But actually, who knows that that is the truth? How can you make sure that this is the truth? And on third-party verification, I'm still sort of a very puzzled. Can we really trust this? Because it can look completely different when you start doing things manually.
Yeah, yeah, it is a problem, and it is an issue, and it's a kind of a funny one really. The I mean, so back in the day when I started in the business, I did my CFA studies, and when you do your CFA, as anybody know, who's done either CFA or done anything like you, as a junior equity analyst, you get ingrained this idea that when companies have an opportunity to make assumptions or choices when it comes to their financial accounting, they will always, always, always make the choices so that they look more profitable than they truly are. So it's given. If they can choose how to recognize revenue, or if they can how they account for inventory, or how do they kind of capitalize their R&D expenses, or anything of that sort, they will always make choices to benefit them. And financial accounting has been there for 150 years, and then there's a regulation for it around it, and there's a kind of a systems and practices around it. In ESG, in principle, exactly the same happens, but there's no safeguards when it comes to kind of accounting protocols of doing that. So companies cheat. Companies in their reporting, companies are very creative of the choice and formulation of indicators. Companies do everything in their power that they can in order to make them more sustainable than it is. Finally, corporate responsible reports they are marketing brochures. They are not equivalent of a financial accountant, and it happens globally. It happens automatically, and to me it's always been very natural to think about it that way. But now we are somehow kind of surprised when kind of companies, they choose to omit certain scope 3 categories and then make them scope 3 emissions look
Do you have any
unofficially related.
examples the recent examples that you know about?
Oh yeah. There's plenty. We kind of inside the company we have a library of cases of misleading choices that the companies make. But my favorite go-to and very recent one is the Apple recent environmental progress report, which is by the way audited, and it's all Apple has been heralded by one of the best environmental reports out there that there is. So they did
Just one correction when you say audited. I know, but it's audited. You know what is audited?
Yeah.
Numbers are not audited. What is audited is the process which was used to collect the numbers. Just to be sure, this is just to be clear. So the numbers are not audited. The process is audited. Yeah, it's another story. But
yeah, exactly. Yeah, so Apple's environmental report is audited, which means that the third party has been verified that this process that leads to this number is verified. So the audit number, or the kind of audit, not the audit, but the Apple's process changed their scope 3 accounting method over the year, and 20 million tons of carbon vanished out of thin air. 20 million tons of carbon is a ridiculous amount of carbon. That's half of Finland, my native country. And there's a political upheaval in Finland just kind of a couple of years ago about how do we count for land use change related, forest related emissions, and that's about the scale of that 20 million tons. Now governments topple over 20 million tons of carbon, and Apple makes it disappear by a stroke of a pen.
Thin air, because they changed the methodology and they changed the way how they calculate that. Yeah,
Exactly. And there's plenty of those examples, which makes it fascinating industry to be in, I suppose.
but
Yes.
do you think, when we talk about this, do you think that the headwinds that ESG is experiencing around the world, that this sort of the case that you're describing right now, there are so many other cases, that's the reason why this is happening? Or do you think it's more sort of a politically, I mean, you have the headwinds in the US is trying to impose its rules and expectations, even in Europe, threatening to do things in relation to EU regulation. What do you think? I mean, because you are sitting on the other side behind the curtain, so to speak, and you talk to asset owners and asset managers. Is your business declining or is your business increasing? Because it should decline if the headwinds are so strong.
Yeah, yeah, it's changing shape. Look, ESG issues are always they exist in this ecosystem of capital markets, regulation, societal expectations, and so on. No, they're always going to be a kind of an ebb and flow on doing stuff, and certainly when when U.S. sneezes, everybody else gets the cold. I mean, anything that happens in the U.S. in the sentiment kind of weighs on everybody else doing things. So if the political zeitgeist in the U.S. says that the ESG is woke and not very fashionable, then everybody else in the world starts to pay attention, and it kind of drags on things and so on. But we've done like I'm talking from a European base, like I think the EU regulation, for example, it has a very, very good intentions, and I think it's fundamentally right reasons. It is there to kind of for consumer protection, for kind of societal importance of capital allocation cycles and so on. But it's been overdone for so heavily. It's just like any other European regulation. I think like there's thousands and thousands of pages of guidance, which just kind of burdens the industry's ability to innovate on a time when we desperately would need that innovation. So yeah, we are kind of I mean, like we haven't seen a much of loss of business because of this anti-ESG sentiment. Um, but it certainly has changed shape in a way that the people tend to be a little bit more cautious for, I suppose, right reasons most of the time. Also, the macro environment, this high inflation, uncertainty over tariffs, the interest rate environment, the kind of the overall uncertainty on the capital markets doesn't help.
No,
Well, it
because
doesn't
you
help the
need
capital markets, but it doesn't help ESG, right?
no, because you need a level playing field and certainty, because this is a long-term game. So if the market's shifting not on a weekly basis now, not even quarterly, it's difficult to sort of hold the course on some of the ESG material issues, financially material that need longer term to materialize. So that's probably the reason why I think there is a step back or sideways in many asset management firms or wealth managers around the world, because the uncertainty sort of pushes you to go back to basics, and the basics is what you actually understand right now. So I agree with you. I think it's that element of uncertainty is certainly contributing to almost put more fire on the some of the elements of the issue that does not work. But when it works well, because many asset managers are really using it to make the investment better. And I think in many cases people are misunderstanding. Not all ESG investments are good or sustainable, for that matter, and not all mainstream investments are good or sustainable or provide returns. So it depends how you do it, and it depends where you do it,
Correct.
how you do it. Yeah, so it's people need to sort of start understanding that this is the asset class like many others, and some people do it well, some people don't do it well. That's sort of how it works. But in
Yes.
terms of developing what you do, I mean, where do you think that this entire sort of a data world of ESG is going? I mean, is it going to be more related to? I mean, are you expecting more things to be developed on products and services going forward? Because right now there's so little data on that. So how sustainable is your product line X compared to your peers? Do you think that that's where we're going?
Yeah, so there's a number of interesting things going on. Like we have to mention AI here. I think the AI and the large language models, LLMs, has changed a lot of the game. So it has brought in a lot of ways how to do things better. I think you mentioned earlier about this kind of a new startups on the ESG popping up. I think uh, a lot of the AI based stuff, and it's not only in ESG, but a lot of the AI based startups. There's so much kind of a buzz around that industry that, and it's going to be and a lot of those are nothing but hot air, pun intended. And the but the um but the how we collect, create, quality assure, data, it's greatly augmented by AI tools, which has helped us to kind of do more and do better. So there's a lot of variants of an ESG analysis that you can do. You can and a lot of data points that you can kind of start to put together, kind of a multiple of different databases, start to kind of organize in a way. But I think we see a future where ESG is not only kind of a thought about it on a very generic terms, but very specifically one issue at a time, one area at a time, and then link to the financial metrics and financial performance, so that you can truly find the value that when it comes to using a kind of very specific ESG data set at a very specific point in time. So we do see a kind of a big future in when it comes to investment solutions. That's for
And
sure.
that's also, I mean, the format wise, that's also related to some of the changes, because traditionally you're using the ESG data that is backwards looking and it's static in many ways. And what you need is more of a sort of a live, forward looking, foresight data on some of these things. And I guess the companies will, learn or will have to learn how to provide a real time data on some of these things in order to get paid for it. And my sort of a take so far is that they're really not getting paid for what they do in this space, because they don't actually understand in many ways how to sell this to investors, because it's not really seen in many cases as something that creates value. And that's at least my take from my side. But I don't know. Do you have a different view on that?
Yeah, no. I think I would agree, and I think it's also the kind of a lack of a mechanism of translating, let's say, what's typically called an ESG issue, let's say carbon emissions, but have kind of hundreds and hundreds of others. Like, how does it translate into a financial value? Like, I think we are increasingly getting better at doing that, and so on. So, and there's what we've seen is that the moment that there is this kind of nugget of information that translates, let's say carbon pricing that translates carbon emission into a financial cost for something, then it gets automatically adapted by the capital markets, and we lack those in other ESG metrics as well. It's not necessarily that it doesn't even have to be regulatory driven. It's just a kind of a question of our collective understanding of being able to do that translation a little bit more systematically. Once that happens, then companies get rewarded for it. That's for sure.
And that's what we want to happen. So, Antti, in terms of the last 20 years, I mean, we've been doing this for 20 years, a long time. And you think that we come to a certain degree somewhere, but we still both realize that there are many other things that will happen next, not only 20 years, but next 5 years. Where do you think all of this is going? What's your sort of the big picture on this?
Oh yeah. Oh, there's so many different directions and different points where you could take it from here. So let's say within the next 3 years, what's going to happen? 3 to 5 years. Okay. So I think world is gonna be more stable again. I don't see a kind of this uncertainty is not gonna continue. We have a few different political issues that we need to solve, and so on and so forth. I think the moment the macro uncertainty or the uncertainty around the macro issues comes, settles, we'll have an opportunity to do ESG a little bit more properly again. So that happens. I think the regulation is here to stay, but the kind of a shape and form, and all of the regulation is gonna find its kind of a bottom of that pendulum. It's not gonna be overregulated or underregulated, but there's gonna be a kind of a natural interface between the regulator and the investment ecosystem globally. So there's gonna be stability over there. We're gonna increasingly have better and more usable tools in our disposal. We have the data that we need, and so on. So I think it's going to be a fantastically balanced kind of a breeding ground for a very very fine ESG solutions going forward. So I'm actually quite optimistic
That's good.
about the
That's
next
good.
next 3 years.
That's good. And let's finish on this one, because I think it was wonderfully expressed by you. Antti, many thanks for joining, and many thanks for all the interesting insights and thoughts about where we are on ESG data, and also in general what this can mean for companies and investors going forward. Once again, thanks for participation. I hope your stay in Tokyo and Japan will be pleasant, and you return back home safe. Once again, Antti, many thanks for joining One Step Ahead Radio.
Thank you, Sasha. My pleasure.
And for all of you listening, please share this with your friends, family, people you think should listen, and we'll be back next week. Many thanks, Antti. Bye-bye.